still morning. Paige, how are you? Are you getting acclimated? All right,
So
plugging
far,
in?
so good.
Okay, well, thank you very much. First of all, I couldn't find our updated slideshow. So, looky here.
I remember Starkey.
Anybody remember that name?
I got to meet with me.
Yeah, that was our company name prior to last year at some point.
But Brad keeps reminding us every week.
Yeah, Brad continues to call us Starkey, so I guess it really shouldn't matter. But I like to do this Mortgage 102 to really kind of dive in and help you guys so that when you come up with a problem, you might remember that there are other solutions and think outside the box. And I promise you, I had this class scheduled long before they scheduled the sales meeting today. Okay, their topic. So I think they stole it from us. But what we do is we do try to think outside the box, which is exactly what today's sales meeting was all about.
That's how I'm going to get the PowerPoint up, so it doesn't say start anymore.
Look there. He's going to think outside the box and do that. So maybe you've brought a few problems, or maybe something that we go over will strike a chord. But we do enjoy talking about this. Again, my name's Randy. For those of you that have not met me before, I'm kind of the team lead for the Starkey. There we go. I did it. For the Certainty team lead. Matt over here on the keyboards. And Paul now joins us too. So we've got a lot of experience here for you. Just to let you guys know, I was a realtor for 12 years. So I sat in your seat before. And I know the challenges and the issues that you face. As a matter of fact, Paul's wife is an agent, I believe. So he knows firsthand what you guys face too. We want you to be able to take advantage of any prospect you might run into. Now, is it fair to say that anybody you run into is going to be able to buy a house? No. Okay, there are going to be people that can't. But what we want to do is if they have an interest in buying a house, we want to get to them early in the process. So if they're not ready now, we can give them a roadmap so that they can get to where they want to be. All right. Somebody said something about a pilot. Yeah, but ours is going to be more like a roadmap because if whatever challenges they are, we're going to try to show them how to overcome those challenges. How are we doing over there? All right. I think we've got it. There we go. Creative problem solving. All we need to know is how to do the technical stuff. All right. What I'm going to talk about then, before we get that up, I'll go ahead and start talking. Let's talk about credit, because credit is probably the number one reason why if somebody's not able to purchase, it's usually because of credit. All right. How many of you guys know what the minimum credit score is for a loan nowadays? Anybody? What do you think?
680.
680? 580? 590? We got a lot of guesses. I mean, truly, FHA doesn't give you a minimum credit score. But the lenders do have overlays onto the FHA requirements. And I think Toshma had it nailed back there. 580 is generally what we use as a threshold right now as the lowest credit score that you're going to get approved for. And to be honest with you, even at a 580, it's kind of tough. You got to jump through a lot of hoops. You got to prove that you've got reserves. You got to prove you've been paying your rent on time. You got to prove a few things. So, generally speaking, when we're looking at somebody, we want to see a 620 or better. That's pretty much the benchmark. Now, every time we pull a credit report, the first question I get when I'm talking to a new prospect is, are you going to pull my credit? Are you going to pull my credit? This isn't going to be a hard pull, is it? Is this going to be a soft pull? I don't want you to damage my credit. Okay? So the first thing I have to do is convince your prospect that me pulling their score is actually in their best interest. Okay? Because every time we pull a credit report, our program automatically, without being asked, automatically tells us how high we can help that client raise their credit score. All right? Do you want to find that? Oh,
near the end.
you already. I'm already there. Where's the? There. Okay. Right here. When we pull a credit report, look right here. It tells us how many points are actually possible for this person to raise their score. This is an actual credit report. I deleted their
Social.
but their score right now is a 625, 611, 614. But look at their potential score: 721, 695, 719. That's pretty substantial. Do you think that might make a difference to that person when they're buying a home? I mean, it's going to make a dramatic difference to that person. And some of these things are pretty doggone easy to do. As a matter of fact, now our program tells them what they need to do. They need to pay down a few items. They're only going to need $3,300. Now, that's not a fee. That's to pay down certain credit cards. They're going to need $3,300, and they will raise their score 107 points.
Individual results may vary.
Okay? Now here it's telling them exactly how they're going to spend that $3,300. They're going to pay down this account. They're going to pay down this account. They're going to pay down this account. It tells them exactly how to do it. There's no guesswork, guys. Look, pay down to $10. Don't pay it off. Pay it down to $10. So credit is king in our business. It really drives what program they're going to be able to qualify for. It drives what interest rate they're going to get. And ultimately, it drives how they're going to qualify because of those things. All right? I hope you do have a question. Go.
So if they get this, say, how long then does it tell them how long it's going to take? Is it going to take 60 days?
Right. Okay. Let's talk about that. What happens is we have a process called rapid rescore. Rapid rescore means that if they do these, how many things are there? 3? If they do those 3 things and send us proof, I don't know what they are, but Capital One, this, and actually there's only 2 things.
Yeah, just 2 accounts.
Capital One. So they pay those 2 accounts down. They get the vendor, Capital One, to send a letter that says, hey, Jim Jones paid blah, 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 down to this, and here's his account balance and everything. We can send that in for a rapid rescore. We can get their score changed in 5 to 7 days.
Okay, so
It doesn't take
Now,
60
it doesn't
days.
take 60 days
If
to
now
go
if-
through the cycle.
If we don't want to do a rapid rescore, let's say we've got a little more time that, maybe they're buying later on this year, as soon as Capital One reports their balance to the credit bureaus is when it gets updated.
And they report
So within
once
30
a
days,
month.
once a month.
Typically they do.
Yep.
Right.
Because there's no hot link between Capital One and the credit bureaus. The only time that scores get updated, balances get updated is once a month when their statement drops, when the Capital One drops their statement.
And is there any way that if they do these things, it still doesn't go up? Like
No.
if something happened?
No. Unless they screwed something else up on their credit report. In other words, it says to pay down these balances. If they opened up a new Visa and took a $3,300 cash advance to do this, it's going to screw them up. Okay? What they're saying here is if you do these things, this will happen. Yes, sir.
Does it say it to do an order? Do Capital One first?
There is actually an order, but everything is cumulative. Okay? So you don't have to do it in steps. In other words, up here it says pay down to Capital One 216, and down here it says pay it down to 147. So you wouldn't pay it to 216, then pay it to 147. You just pay it to 147.
Yeah.
Okay? So, guys, credit is, I mean, it is critical. It is critical to take care of the credit. And that is one of the reasons why we encourage you guys so much. And that's why Cynthia was up here talking about the 9-month closing that we had, is because we had a lot of credit work to do with those people. Okay? Now, can we solve everybody's credit problem? No. What's the lowest score you've seen recently?
437.
Okay? If we run that person's score with a 437, it's probably not going to give us 107 possible points to increase their score.
Took a lot.
They
of
have a 437 for a reason.
Took a lot of work to get down there. It'll take a lot of work to get back out.
Right. We do have a couple of credit repair companies that we refer people out to when it gets to be over what we can handle. But on marginal cases, and I would say in the majority of cases, we can give them a roadmap to help you get your client where they need to be. Okay? And you know what? Credit doesn't always make sense. It doesn't always make sense. If you've got, let's say you've got 4 credit cards, you owe $1,000 on each one, which you're pretty well tapped out, and you get this offer in the mail. Anybody ever get one of those offers in the mail? If you have good credit, you do. And the offer in the mail says, hey, consolidate all your debt onto this one brand new platinum, gold-plated, silver Amex card, and you'll have no interest for the next 5 years. And you transfer the balances from all these 4 accounts over to this one new card with 0 interest, and you close out these other 4 cards, and now you've got no payment for 5 years. Does that sound like a great idea? It does. It sounds like a great idea. But guess what it's going to do to your credit score?
What?
It's going to put it in the toilet. Because you just closed out 4 credit lines with good credit history, you opened up a new account, and now you're tapped out on a credit card. Okay? So what I'm saying is it doesn't always make good common sense, the credit bureaus. Did you also know that Credit Karma, anybody ever heard of Credit Karma? Mm-hmm. Does not give you an indication of what your mortgage credit score is.
Right.
Yeah. No, I mean, Credit Karma, MyFICO, all of them, there's really 5 different industries that pull credit, and I'm going to forget the 5th. But mortgage is one, Credit Karma is given like your consumer credit score. That's if you're applying for like a Capital One card. Obviously, a Capital One card and a mortgage, 2 slightly different things. So we grade things differently, we weigh things differently, we use different algorithms. So Credit Karma is a great indicator of movement up and down, but it's definitely not the gospel when it comes to like what your actual score is. And I mean, my biggest objection when I talk to people is, I don't want you to pull my credit, it's going to tank my score, I'll tell you what my score is that good enough? Well, the answer is really, unfortunately not. We're not just looking for a score, we're looking to see what kind of debt someone's carrying every month. We're looking to see if they've had a past bankruptcy, foreclosure, short sale, any disputed accounts on their credit, but also looking at their score. So what I tell people is never too early to start. It is a hard pull, it's probably going to ding you 3-4 points, but with these tools our goal is to get you back those points and then some. It's also valid for 120 days. So after 4 months, it's as if I never even pulled your credit. You get those points back. So especially for people that are looking to buy, and I have people that are buying next summer that we're talking to now to get them on the right path so that when the time comes, they're in a great position and ready to pull the trigger. And there's no surprises. That always sucks is when you've got someone whose lease is up next month and now they can't, I'm like, you should have called me 3 months ago. You'd be buying a house, and now you're going to be,
Something else they do when you pull your credit through a mortgage company, it shows a real estate pull. It doesn't, so it's not, there's no effect on the score. It's a real estate pull. They list them next to the date of Century Certainty Home Loans pulls your credit, it says real estate transaction.
Right. And so if another mortgage company pulls it within 30 days, there's no effect on your score. Yes, ma'am?
Can you repeat what you just said about it's almost like the points come back after the 120 days?
Mhm.
What is that for?
So a credit inquiry stays. So when we do an inquiry, we do a pull. It stays on the person's credit report for 4 months. When the 4 months are over, the inquiry just drops off. So whatever point impact our pull had is removed.
Right. It's not a permanent impact. It's only temporary. As are most things on your credit report. You know, they're all temporary impacts. So that's what we're trying to change. Any other questions on credit? Because I could talk about credit the entire time, but you probably don't want me to do that. Would you like a free advice on how to raise your credit score?
Yeah, sure.
Okay. If you're like most people, nowadays you get points and miles, you get cruise miles, you get airline miles, you get hotel points, whatever. You're using this card because you get points. Anybody? Yes? Does that sound familiar? Okay. So what a lot of people that I talk to do is they have one card designated to pay all their bills. Okay? Like an American Express. So they use their American Express, and every month they pay $5,000 worth of bills, rack up their American Express to $5,000, which is what their credit limit is, and then they pay it all off. Right? The next month they rack it up to $5,000 and pay it all off. Sounds like a great idea. They're really getting a lot of miles. It actually is a good idea. Okay? Because you got to pay it anyhow. Why not get some miles out of it? Here's the problem from a credit perspective. When I pull this person's credit, I look at it and I say, gosh, you owe $5,000. And you say, no, I paid that 2 weeks ago. Well, I just pulled your credit report today. There is no, like Matt said, there is no hot link between American Express and the credit bureaus. When you pay your bill, it doesn't instantly show on the credit report. The credit report only knows what American Express tells it. And they tell the credit. So when American Express prints your statement every month that says you owe $5,000, they send it to you. They also send it to the credit bureau. So then you pay your bill, but they don't send anything to the credit bureau that says you paid your bill. Next month, they print a statement. How much do you owe? $5,000. They send it to you. Who else do they send it to? Credit bureau. So I don't care when I pull your credit report, you're going to owe $5,000. Even though you may not owe a nickel, it's going to show $5,000. So if your credit limit's $5,000, it shows you owe $5,000. Those are some negative points. You want that spread to be really big. The bigger that spread between your credit limit and what you owe, the better it is. There's a very simple solution to that will get you 30, 40 points. You go to American Express online, or you look at your statement, and you notice every month American Express prints my statement on the 15th, or the 10th, or the 12th, or whatever it is. American Express prints my statement on the 15th and sends it to me, and I pay it right away. What you do is you go in online and you pay your bill before the 15th. You're going to pay it anyhow, right? You just pay it a week early. You go online, figure out how much you owe, when the statement's going to drop. You pay it, so now the statement drops, and what does it show you owe?
Nothing.
Who are they going to send that to?
The credit bureau.
Credit bureau. So now, if you do that on a continual basis, anytime I pull your credit, it's going to show you owe $0, even though you may owe $5,000. No extra charge for that advice. All right? It's a great trick to raise your credit score. You know what another great trick is? I told you that the difference between your credit limit and what you owe really determines what your score is, or how many points you get or don't get. And the tighter that is, the worse it is. So you want a big spread between what you owe and what your credit limit is. If you can't pay it all off, pick up the phone and say, hey, MasterCard, raise my credit limit. So now instead of a $5,000 credit limit, now you have a $10,000 credit limit, and all of a sudden that spread is huge. You can raise your credit score instantly that way without costing you a nickel.
Just don't rack up that extra 5.
Yeah, don't spend that extra 5, but no extra charge for that either.
So what is the ideal percentage of your balance?
30% or less.
Okay.
Usage, yeah. It'll vary, but the bigger the spread, the more the points is the main idea. All right, so we came through a financial crisis a few years ago, 8-10 years ago. Those of us that were in the business at that point, it had a major impact on us. A lot of foreclosures, a lot of short sales, a lot of bankruptcies. So this was just a chart to show you that just because people have had a bankruptcy or foreclosure, short sale, and you run into them and they say, oh, I had a bankruptcy a couple of years ago, I don't think I can buy anything for 10 years. That's not true, okay? There's so many loan programs out there right now, this chart isn't even updated because it keeps changing. We have programs right now where you can get...
There's a fourth column, actually,
yeah.
with zeros along
just about any
everything.
So there's programs today where if they came out of bankruptcy yesterday, we can get them a loan. Foreclosures, short sales, things like that. The waiting time periods have been drastically reduced. So don't kick anybody to the curb too soon. Again, get them to us, let us talk to them and figure that out.
So if someone's in bankruptcy and say it ends in 9 months, but they have a good credit score,
Mm-hmm.
you should send them to you?
You should send them to us regardless.
Okay.
Yeah, because you don't know if they have a good credit score or not.
No,
Right?
I'm just going by what they said.
That's right. That's right.
Buyers are liars.
I
Yeah.
know.
And I find out that a lot of people say, "Oh yeah, my credit score is pretty good," and I look at it and I'm like, "Oh my god, compared to what?" And I've also talked to the other people that say, I'm not sure. I don't think my credit's that good. And I pull it and it's fine. So you don't know. You don't know until you know.
Okay.
So find out sooner. Let's talk about another problem that a lot of people run into is that they're short on cash. All right, this is a big one. Are we being taped on this? I'm going to divulge information that shouldn't be distributed. People that are short on cash. I don't want to buy a home yet because I haven't saved up 20% for a down payment. I hear that sometimes. Okay, and I understand that, but it's kind of old school. We're looking at leverage. Home values are going which direction? Okay. Now, fortunately, right now, interest rates are actually going down or remaining flat, but nobody expected that, and I'm sure pretty soon they're going to go the other direction. So is it better to buy now or later? Well, we're all in the business. We know it's better to buy now. Okay. So maybe saving up for a 20% down payment isn't the smartest thing to do. So where can we get this money from? A lot of different sources. What lenders don't like, let me start there. We don't like green cash. And some of you may either know somebody or maybe even you yourselves. You have a safe in the basement or someplace else and you put green cash for a rainy day. Okay? I'll give you my address because I do it. If anybody wants to come rob my house. I do have a safe in the bank, and I put some green cash in there for a rainy day. But
That's my inheritance.
yeah, but we can't use that as a down payment because it's not sourced. After 9/11, the government looked at lenders and said, "You know what? We're going to regulate you guys because we want to know if somebody's trying to launder money and if they're a drug dealer." Or a terrorist, and they're bringing money in through that way. So we have very strict guidelines as lenders as to what we have to look for money, and cash is definitely a huge red flag. But there's ways to get around it. Oh, I'm sorry, did I say that?
Well, besides getting around, which I'll let you lose your license in a minute, there's also different loan programs that are lower down payment. If you're a first-time home buyer and conventional, we can do as low as 3% down. FHA is 3.5% down, minimums. VA, if they're a qualified veteran, they qualify for 100% financing. That is borrower specific. That is not, doesn't have to be in a certain area. They served our country and they get the benefit of 0% down financing. USDA, that is geographic specific. So you're not gonna be able to do a USDA home loan in Dunwoody. It's probably gonna be in like Douglasville, out past Douglasville, North Forsyth, more rural locations, but you don't have to buy a farm. You don't have to start raising chickens. You can do it on a townhome, condo, etc. It's also 0% down. So HUD or down payment assistance programs.
DPA is down payment assistance, by the way.
Down payment assistance programs. There's quite a few of them in the Atlanta area. There's quite a few of them in the state. A lot of them are county specific. So I know there's one in, Fulton, DeKalb, Clayton, Douglas are the big ones right now. We can do a $15,000 grant if they qualify.
There's still some of those available?
About 400 of them, I think.
Yeah.
So those are great. Those are great. What I'll say is for down payment assistance is if you're coming up with the down payment yourself, the window to qualify is about that big. Down payment assistance, it's about that big. They've got some stricter requirements, stricter credit requirements. They don't let people stretch their budget all the way. What I see great for the best clients for down payment assistance are teachers. They usually typically have good credit. They just can't accumulate a lot of money for savings and down
They're in
payment.
the income slot that fits well with the down payment.
Yeah, 45 to 55, 60,000 income is
Right.
really the sweet spot because they make enough to qualify for the payment, but they don't make over the income limit for these programs.
Amazingly, one of the things a lot of people overlook when they're thinking about going and buying a home is right here. 401k. People that aren't as old as me that can't take their 401k money out yet, okay, because they say, I'm going to get penalized, right? Anybody know anything about 401ks? If you take a withdrawal before you're of age, there is a very stiff penalty, okay? And people don't want to pay that. But what people don't realize a lot of times is that they can borrow against their 401k. Not make a withdrawal, but actually borrow against it and use the 401k as collateral. Now that serves two benefits. Actually, it frees up a lot of cash for them. The second thing is we don't have to count that repayment debt in their debt ratios because they're borrowing their own money. So it's kind of a nice thing. They have to check with whoever's handling their 401k. There are some restrictions. I know the Atlanta PD, you can't do it if you're Atlanta PD.
Georgia Tech.
Georgia Tech employees can't do it, but for the most part, most people can do it.
Can you use other types of borrowed money? Let's say I open up a Bank of America card and I get a $10,000 cash advance. Oh.
Secured debt.
No unsecured debt.
Okay. Can I ask a question about the 401k? Because I was in a conversation with someone this morning that just said to me she was considering getting money from her 401k, but they told her it would be counted as income and she would have to report it on her income
Okay,
tax.
what you're talking about is a withdrawal.
Okay,
If they withdraw money from their
Okay.
401k, it would be counted as income.
but not a
And
loan.
taxed as such.
Right.
Which is why
Now, is this a 401k that she has with her current employer?
Yeah,
Okay, should be okay.
okay.
Because here's the thing. If it's a 401k rollover where it's a previous employer, you can't borrow against it.
No,
But if it's a 401k with your current employer, you can, most of the time, you can borrow against it because then they pay it back out of your payroll.
Okay.
They just make a payment and out of your paycheck every time you're paying it back.
Okay.
All right? Yes.
When you all,
Or were you just waving?
no, I have a question. When you all pre-approve somebody
does your system like if they qualify for USDA or DPA, will the system automatically tell you, or you need to know up front if they are pursuing DPA?
So typically what I'll do is, I mean, there's different spots in every loan application. Let's talk about employment, let's talk about income, let's talk about assets. And if they leave the assets blank, or I see that they've got $6 in their checking account, I'll say, hey, you know, did you have a number that you had in mind as far as what you'd like to put down or a percentage? And they go, oh, well, you know, I was kind of thinking about, might need some help there. And that's when we open up that conversation.
I mean, we certainly do have a conversation with them about those things. Now, do we talk to them, say, hey, you're qualified for USDA? You don't necessarily qualify for USDA because USDA, like Matt said, is geographic specific. So it's homes that are in the outlying areas. So it's anybody in this room could qualify for USDA. Whereas if we're talking about VA, only the people in this room that are veterans could qualify. Okay? So it's a different concept. When we're talking about down payment assistance, yeah, there's a lot of different programs out there. Every one of them will tell you if you don't have to use this, don't. Because what he was talking about was the window gets to be very tight. Some of the programs are grants. Some of them are liens, like Georgia Dream is a lien against your property that you eventually have to pay back. Unless you're doing an HHF, which is the hardest hit fund, which then you don't. But again, there's a lot of things involved in that. And typically interest rate is set by the DPA companies, not by the lenders.
With USDA being geographical, the requirements for that particular loan, do they align more along like with FHA or conventional, what the requirements are to qualify?
Yeah.
Probably more along with the FHA.
Right.
But I mean, you can go to USDA.gov and you can see, I mean, it's a shaded, unshaded map of like qualifies.
And there's a place just like MapQuest. If you go to USDA, you type in the address and it'll tell you if it's eligible or not.
MapQuest.
Right, yeah, I'm thinking more along.
That's okay, Randy. I know what that question is.
Go to
I
your,
know what it is.
hey, he had an AOL email address until about 6 months ago.
I'm not giving it
Okay, he's got free discs. Yes, Tom.
A lot of times we are having these preliminary pre-qual conversations, and I don't know about everybody else, but I always get the question, well, where's the down payment assistance? I don't know. Is there I know enough to be dangerous. So is there something in between that the client can look at as a trusted resource before they even come to you? Or where can we advise them to go just kind of look at what might be available to them for down payment assistance?
I have a summary page. I know there's WE DeKalb, which is Workforce Enhancement DeKalb. Properties that will be located in DeKalb County. There's Invest Atlanta, which the address has to be Atlanta, pretty much.
Honestly, your best resource is standing right there. That's where I would send them. And then let him listen to what they are saying and then direct them to where they need to be, because these are most of them are very geographic specific, county by county. I mean, except the Georgia Dream obviously covers most of the state. But then when you start getting into, you're probably familiar with the PENN program with Georgia Dream. You know, that's very specific to certain individuals. So I don't know if there's like a website that says here's all the down payment assistance. There's none that I'm aware of. Again, I put myself in your shoes because I was once. I'd say, oh, you want down payment assistance? Let's get you pre-qualified first. Talk to Matt. He'll help you. If you don't like him, then you can talk to Randy. No, but
Here's the biggest misconception that I hear a lot is, I'm a first-time home buyer. What do I get?
Right.
What do I get? So look at it from a lender's point of view. I'm a first-time home buyer. I've never made a mortgage payment in my life. Randy's owned 10 homes, on-time payments for every single one. Which one of us is a bigger credit risk? Me. I am. A lot of down payment assistance programs, I mean, it was rampant 8-9 years ago because we had a massive inventory of homes and not enough buyers. So there were buyer incentives. 0% down,
Well, there was even the federal government came out and gave the first time home buyer thing, and that's where a lot of people still get that. Remember, we had a first time home buyer program thing that they were given,
Right.
what was it, $5,000 tax credit or something like that? But then the fine print, which nobody read, was like if you sell the home after 2 years, you got to pay it back or a portion of it back.
So now you guys are aware the market now is pretty much flipped. There should be like first time seller programs.
All right. Any other questions on cash shortage? Yes.
Okay, so how do you convince your buyer to stay with you when they go buy new construction? I know this kind of terms.
As a lender?
Yeah, because sometimes the down payment assistance, that's what they see, because the builder is offering $5,000 to $7,000 to help them.
Yeah, we got a little sour taste in our mouth about that.
Yeah,
Just to work for one,
and
it's easy.
hard.
It's
Well,
easy. Their
it's
rates
hard
are a
for-
0.5% higher.
Yeah,
Well, and I hear you,
Mhm.
but it's hard to explain that to a new home buyer.
It is.
Who doesn't really understand that.
True.
All they see is, I don't have a lot of funds, and what I hate is if I send them to Randy, and Randy's done all this to get their credit right, we may have worked with them 4 months, and now they're ready to buy, and they go to the builder, and the builder's like, oh, we're gonna give you $10,000. And I'm like,
Get a kitchen upgrade.
Yeah.
but do you understand
It-
that that's gonna cost you money in the end? Like, my line is always, nothing is free. So my lender has worked with you and got you to this point, and no, you don't owe them any loyalty, but you should trust that they know what you're dealing with. Those builders don't. They may get you, and you have to start all over again what you've already been through.
So how every lender works is you've got, let's say, closing costs on one side of the seesaw and interest rate on the other. And we typically will quote where the seesaw is right here, where there's no credits, there's no charges, interest rate is interest rate. Now you can go the other way and say, well, in your scenario, maybe I need a $5,000 lender credit and I'm okay with a 0.5 point higher in interest rate. We've got clients that go the other way. They say, I've got extra cash. I plan on being in this home for a while. I'm going to throw some money at my interest rate, buy it down. So it's really, we have clients here, and like this. So it's really just about what's important to them. If it is the cash to close, we can do lender credits in exchange for interest rate, just like the builder or the builder's lender can.
The one thing that we do is just an opportunity. If we're working with this person for a long time and they do end up in new construction, just an opportunity. And I understand sometimes they've got this built into the price of the house. Sometimes they have it built into the interest rate. We know it's built in someplace, okay? Because money just doesn't grow on trees. And we all draw from that same pool of money, all the lenders do. But just give us an opportunity to look at it and make sure.
And really it depends on not the dollar amount, but the percentage of how much they'd be borrowing. So if it's a $5,000 credit, but it's a $500,000 home, yeah, we can compete with that.
Pretty easy to.
If it's a $10,000 credit on a $150,000 home, probably not going to be able to do that.
Yeah. It's my batting percentage of keeping those is probably 60 to 70%. I'll keep, and the others, I'm just going to flat out tell them, you know what?
It may be better.
If it were me,
I'd take that deal, and we'll shoot straight with them. But that's you got to get to know us. It's not all about the almighty dollar. It's about taking care of the client. And for us, you guys are our clients. So we want to take care of your clients so that we take care of you. Okay? All right, let's move on. Debt ratio. That was brought up this morning, actually. Amisha brought it up. Is that she had a $785,000 house, the taxes were all jacked, and all of a sudden her buyer didn't qualify. Well, that wasn't because of credit, it wasn't because of cash, it was because of debt ratio. We have certain debt ratios that we have to adhere to, meet the guidelines for certain programs.
And it's not gray areas, it is razor sharp.
Yeah, it's razor sharp. Conventional versus FHA versus VA, they're all a little bit different, but each program has their own debt ratios that they have to adhere to. Just so you know. You know what? They're all three different. Any guesses on which one is the most liberal? I got conventional loans, which is Fannie Mae. I got FHA, and I got VA. Any idea which one's the most liberal? How many think FHA? How many think conventional? How many think VA? Those hands are right. Okay. VA is absolutely hands down more liberal when it comes to debt ratios.
I got 64%.
I had a 67. I got you beat.
What?
Had a 67% back-end ratio on a VA.
So
Okay.
the ratio, you take all of their minimum monthly payments that they're making that show up on a credit report, plus the mortgage that they're going to have, divide that by their gross monthly income. 67%.
67%.
67% of their income was going towards their debts.
Yeah.
So for comparison purposes, conventional, well, let's go then. So VA, we had a 67%. FHA, we can go to 55, usually 55. And then conventional drops down to either 45 or 50, just depending on.
Right. Conventional's the most strict. Fannie Mae. So, but even though we're talking about debt ratios, again, what we're talking about here is thinking outside the box. How do we get debt ratios in line? We're looking at your client, we run their credit, we look at their income, their debt ratio's 70%. We don't just say, hey, sorry, call us in a year when you pay down some debt. What we'll do is we'll look for ways to make this deal work, okay? A lot of times we look at the credit report and there may be, maybe there's a credit card with a $1,000 balance that's got a $200 a month minimum payment, and it's throwing their ratios all out of whack. So instead of, you know, Mr. and Mrs. Buyer, instead of putting 10% down on this house, let's put 5% down on this house, and let's take that other 5% that you have, and let's pay off some of your credit card debt. Okay? So what you want to do is, I mean, you want a lender that's going to look outside the box for ways to make the deal work. So a debt ratio is a critical part of the equation. Now, how do we make that work? Sometimes we pay down debt, right here. Sometimes we can get gift funds. Sometimes you can get a cosigner. I don't know that that's up here. Now we've talked about critical things of a loan.
Sorry. I thought I had my ringer off.
We have critical part of loan. Most critical, credit, income, assets, liabilities, debt ratios. All right? When is a cosigner going to help somebody? Is a if you've got really crummy credit.
And this is a scenario that Cynthia talked about this morning.
Is a cosigner going to help you? No. No, because we look at all the borrowers. If all four of you guys right here were going together and buying a house, we're going to look at your credit, your credit, your credit, your credit. Okay? We're going to take the lowest one. That's what your whole file is going to be rated on. So a cosigner doesn't help you if you have bad credit. A cosigner only helps if you have too high of a debt ratio. Okay? Maybe bring that debt ratio down. Maybe mom and dad cosign. Maybe Uncle Bill cosigns.
Because now you've got multiple incomes
Right.
to spread over
Okay?
one debt.
But again, that's an outside the box. Maybe, gosh, I just can't get this. Well, maybe Aunt Edna in New York can cosign for you. Okay? What happened to our pizza? We gotta feed these people. All right. Any questions on that? Oh, I know what you asked. Is that off yet? Cash in the bank? gift funds. Isn't that up here?
Yeah.
Gift
It's
funds.
not illegal.
We can get, it's the easiest way to get, if you're short on cash and you're doing a conventional loan and you're getting money, here's the pizza, look at there, is to have it wired directly into the attorney. Because there's basically no paperwork that needs to be done. So if my son is buying a house and he's short on cash, I can wire money. I don't want to give it to him. I don't want to write him a check. I don't want to give him cash. I don't want to do a bank transfer. If you're the closing attorney, I want to wire it directly to you. Because then as the lender, all I have to do is verify with you that you receive that money from my account. Whereas if I give it to him, it's got to go through a different
I didn't know that. Okay.
invasive.
Wait, say that again?
That works for conventional loans.
Conventional only.
Does not
Gift
work
funds.
for FHA. Yeah.
Gift funds, we do not even need a bank statement from the donor.
Right.
On
Now,
conventional.
If it
If it's
conventional.
Conventional
Okay.
only. FHA, we need bank statements. Conventional, don't need a bank statement, just need to confirm that the
it's-
attorney received it.
It's still, even with an FHA, it's still best to have it wired directly to the attorney.
Correct.
Would you do that ahead of time? Like,
Yeah, do it a week before.
That's
Well,
all.
so I talked to
Yeah.
a client that said, my dad's gonna gift me $20,000, and I say, perfect. Have him keep that money in his account until a couple days before closing.
I was on the phone with somebody yesterday.
how
That's
do you confirm that that's really gonna happen? I guess that's my question.
it's a condition of the loan.
Right.
We have the attorney verify it.
Okay.
Right. But here's what it avoids. The person I talked to yesterday, actual story, closing that I have going on, closing in 2 weeks. Parents are gifting 30% down payment. It's $400,000.
Nice parents.
They're doing it because he hasn't sold his other home yet. So the kid has the money, but it's tied up in equity. So the parents are going to gift $120,000, right? They're willing to do it, but they called me directly, like, we don't want our son to know what our financial position is. So we don't want our son to see our bank statements and our net worth, and we don't want him all up in our financial business. And I'm like, no problem. Here's how we do it.
Like, I'm the same way.
I said, I'm the same way. So they were thrilled to know that they could solve it that way. They don't even have to give me a bank statement.
That's a good.
Okay? It's wonderful. So again, it's these kind of knowing how to handle these things that kind of makes us a little bit different and thinking outside the box.
It's all planning. It's tackling it early instead of trying to problem solve, instead of trying to backtrack.
Yeah, be proactive instead of reactive is really what it comes down to. Income. I hear from a lot of people that say, well, I'm self-employed, so I don't think I can buy a house. How many of you guys in here are self-employed? Me too. Am I in the way? Or you just want to take my picture? Wait. Go ahead.
You're in the way right now.
Okay. All right. So look, I'm self-employed too. But guess what you guys get? You guys get a 1099, right? Guess what we get? We get a W-2. I'm still self-employed. All right? Well, put yourself in a lender's shoes. You're brand new in the business. Just starting out. Okay? You had a great first 6 months. You made $50,000 your first 6 months. As a lender, are we going to give you credit for making $100,000 a year? No. No, because maybe that first 6 months, she sold every one of her relatives a house and she's out of relatives now. Okay? So now she got to join the real world and find out where the real buyers are. So as a lender, we want to see a 2-year track record for several different types of income. Self-employed is one. Commission is another. Some people are on a base plus, they get a base salary plus commission. In order for us to count that commission, we want a 2-year history. Part-time is another. They're working part-time jobs. We want to see a history.
Bonus,
Bonus is another.
overtime.
Overtime is another.
And there is pizza in the back now, guys. So,
Help
don't
yourself.
all go at once.
And I'm not trying to make you guys loan officers. I'm really not. I've got plenty of competition. I don't need any more. But I'm hoping that one thing that we say might resonate with you and help you either make a deal or save a deal in the next few
Let's
months.
jump to the bridge gap.
Okay.
What's up, Whitney? What you got, girl?
I want to talk about the people who actually are paid in cash.
Do they report it on their taxes?
Okay.
But I mean, because you don't want to see cash deposits and stuff. Like if they're if it's valet, bartenders.
If it's on the up and up and it's legit, then
That's fine.
Okay.
That's fine.
It's the people that get $500 a week in cash, and then when they file their taxes, they say, didn't make any money this year.
Okay, so when we come across these cash people, you can still pre-approve them.
Yeah.
Assuming,
Oh yeah.
Yeah, he's
If
actually.
they're in a cash business,
You,
I financed the pole dance.
I was gonna ask. How
Yeah,
do you
that's
do
what
that?
I'm saying.
I did.
Okay.
Okay.
How do you do that?
Well, because
Are you
what's that?
going-
she's
are
got to
you-
report it.
Yeah.
Right. I mean, it's a legal job. She was getting paid and she was making
Making her
consistent
deposits.
deposits.
Okay.
Now, they weren't the exact same amount.
But they're
You
not-
know, she made more on a Friday than she did on a Tuesday, but it was all legitimate and we could document it. We could look in her bank statement. We can do it.
Okay.
Matter of fact, we actually have bank statement loans right now where even if they don't report it on their
Oh, that's the one where you
Income
don't have
tax.
to show the tax.
So the bank statement loan is what
We-
they have to do.
no, not necessarily. Not necessarily.
We have a bank statement loan. They've got to be putting 15 and 20% down. We track deposits as income.
All right.
But I mean, there's more hoops. I mean,
Yeah, but a bank
And the-
statement loan is outside the box, and they're going to pay a little bit higher interest rate. We also have a loan, by the way, we were talking about credit. I'll just throw it out there that we also have loans for people with no credit score. What? Say what? We have loans for people with no credit score.
not people that have a 467.
Right. Yeah, if they got a 0, and a 467, that ain't gonna work. Okay? But if they got a 0, and a 0 for their credit scores, we've got a loan for them. And it's a great loan, too. As a matter of fact, it's a Fannie Mae loan.
It's conventional.
Yeah. All right. This is what you guys are gonna have to put on your thinking caps here. Okay? Because every time I go through this and explain it, I get these glazed looks like people are stoned out there looking at me. This is way outside the box, and I'm going to take it nice and slow. This is an actual scenario that we closed. All right? So, I know it's a little hard to read. We had a purchase price of $260,000. The borrower was putting 20% down, so we had a loan of $208, which gave them a payment of $1,023 a month. They're happy with that. They qualify for that. They're going to put $52,000 was their down payment. 20% of $260, you can do the math in your head. 20% of $260 is $52,000, and a payment of $1,023. They're happy with that, right?
Buyers are happy.
Buyers are happy. Sellers happy. Appraisal comes in $245. It's $15,000 low. What's your first instinct?
Well, shit.
Yeah, that's what was said today. Your first instinct is, well, okay, let's see, $15,000. If I can get the seller to come down 5, get the buyer to come up 5. Other agent and I will split the other 5, right? I mean, come on. I was an agent. I know how we think. That's probably the first place we'd start. Not necessarily what you have to do. So what this agent did was took the appraisal to the seller sellers dug their feet in and said, look, my house is worth $260,000. I had multiple offers. I'm not lowering my price. I'm staying at $260,000. The buyer said, look, I know what the market is like. I think it's worth $260,000 also, but I don't have any more money. I'm putting all my money down. Okay? So here's how we solved the problem. We did, as a lender, I have to base my loan percentage, like if we're doing an 80% loan. They're putting 20 down, so we're doing an 80% loan. I got to base that on the lesser of the appraisal or the purchase price, whichever one's lower. And in this case, which one's lower? $245,000. So now I'm going to keep my loan at $208,000. All right, I kept my loan at $208,000, but now instead of an 80% loan, it's an 85% loan. I'm going to keep my payment at $1,023. But what happens when I put less than 20% down? What's that nasty little two-letter thing that comes in? Or yeah, a lot of people call it a three-letter word. The PMI or MI or whatever you want to call it. Mortgage insurance comes in, right? Well, that would have taken my payment up, and all of a sudden I don't qualify anymore. So I want to do that. So there's a lot of different ways you can pay mortgage insurance, and most people don't know this. And most lenders don't even talk about it.
There are 4 ways to pay mortgage insurance.
What are they, Matt?
Well, the most common is monthly. They can pay it monthly as part of their mortgage payment. Drops off once they reach that 20% equity threshold. So that's one. Number 2, you can roll it into your interest rate. So pay a slightly higher interest rate, but never pay PMI. Number 3, you can actually finance it. You can roll it into your loan. And the 4th, which is what worked in this scenario, is a one-time premium at closing. So they pay it one time. They don't pay it monthly. They don't have to pay it every year. They pay it once, forever and ever, amen. They won't pay it again. So in this scenario,
Something sounded like the same. I thought it was the same. What is the difference between paying it monthly and putting it in your loan?
A lot.
yeah, because if you're putting it in your loan, then you're borrowing more. Whereas if you're just paying it monthly, then the loan is staying here and you're just paying
If you
it.
put it in the loan, it never goes away.
Right.
Yeah, it's different. If you pay it monthly, it drops off. All right, so in this case, we opted for a one-time, what's called LPMI, lender paid mortgage insurance. The premium was $1,456. So in this particular case, the seller said, I'll pay the $1,400, but I'm not paying $15,000. Okay? So instead of paying an extra $15,000, it was only $1,456. Now, what stayed the same? The buyer was coming up with $52,000 initially. How much is he coming up with now?
52.
He's still coming up with 52 because he's putting $37,000 down. Plus, he's actually paying $260, but we're only lending on $245. So he's got to come up with that 15 difference. So he's still putting $52,000 down. So going into this transaction, the buyer is paying exactly what he was going to pay initially per month and down payment. Nothing changes for this buyer. The seller, instead of coming out of pocket, lowering their purchase price $15,000, sacrifice $1,400. But more importantly, where'd the real estate commission end up?
Not touched.
Not touched, but guess what else? It was also based on the purchase price. Okay? So y'all weren't affected either in this.
And so does the seller have to pay that $1,456?
Anybody can pay that $1,456. You as the agent could have paid it. The buyer could have paid it. The seller could have paid it.
Could have split it?
Uncle Bill could have paid it. We don't care who pays as long as somebody pays it.
But the buyer ended up paying it in this scenario.
In this case, the seller ended up paying it.
Seller paid it.
Is the premium the same?
No. The premium is based on, it's a percentage, and it's going to be based on credit score, how much they're putting down. So in this case, technically they're putting down 15% in this scenario. So it's based on credit and how much they're putting down.
There's a big matrix, and it's calculated that way. Now, let me tell you when this wouldn't work. FHA, not going to work. You get a low appraisal on FHA, guess how long that appraisal stays with the property?
6 months.
6 months.
See, the key to this working is that they were putting down 20% initially.
Right.
Because we were able to move our LTV, our loan to value, from an 80 to an 85. We had room to work with. So if it's FHA and they're putting down the minimum, there's no room.
Even if it's conventional and they're putting down the minimum, we can't do it.
So instead of going back to the seller and go, man, you gotta give up 15 grand, he goes, hell no. Will you give up 1,400?
Right. Yeah.
Big
Now,
difference.
again, that happened to be this scenario, but it was a real scenario. The buyer was willing to pay more than the appraised value. Okay? So is he overpaying for the property? Technically. Okay? But the seller wasn't willing to budge, and the buyer was like, I think it's still worth it.
I want the house.
I want the house.
So if they're putting down 20% or more, this will work all day. 15%, probably yes.
Yeah.
10%, maybe. Less than 5, probably not working.
So, pretty out of the box solution? All right. So now
Did it make sense?
Yeah.
you guys understand what we did? Yep. I don't want you to understand it too well because I want you guys to use this. Okay.
What scenarios out of the box that have either you've ran into that have killed a deal that we could maybe
We can
share
bat around.
and we could
We don't know if we can solve them.
everybody could benefit.
bat
from.
them around.
Yeah.
So, and I'm a new agent. July 1st is my 1 year. And everything that could have happened has happened. So I had a buyer, qualified, conventional loan, good credit score, good income, down payment, and we're ready to go. We're a week before closing, and the person who was living in the house was paying one set of taxes because he had already claimed homestead. When the title company did their search or whatever, they came back with the homestead first, but then I guess somebody looked at it again and said that's not the actual taxes on the house. Right. So when they got the actual taxes, it pushed my buyer out of qualification.
Very similar to what they were talking about today, but
yes.
I mean that was probably legit. Okay, so we look at the taxes up front just to kind of address that. We do look at the taxes up front and see if they look like they're legit, because sometimes if the seller has senior exemptions, those taxes can be very, very low, and we won't estimate that number.
Just so you guys know, before you actually put an offer in, what we like to do is, you sent us your client, we've got them pre-approved, they're ready to go, you guys are out shopping. Perfect. You find the right house, say, hey Matt, we found the house, we want to offer $300,000, here's the address. I go, awesome. I go to the county website, I look up the taxes, I look at the actual tax bill on that property. I look for homestead exemptions, I look for senior exemptions, what other L1, L2, R2 exemptions are there? And I look to see, what is the actual tax that we're going to use down the road? And I plug that number in, and I see if it's going to work or not. And then what I do is I'll send you the pre-approval letter that's offer specific. It's got how much you're offering. It's got the address of the house. We'll call the listing agent after you put an offer in. Say, hey, look, I've been working with John and Mary Homemaker. I've seen everything. I've looked up your tax bill. I know they qualify. They're as good as gold. And if you're up against multiple offers and you know they're all pretty much similar, but I'm the lender that picked up and gave you a warm and fuzzy,
That makes a difference.
it can make a difference.
But she actually was able to buy the house because we found out 3 days before closing, which in my opinion, we should have known way before then. And then she found out like the next day in her email, because she wasn't working, she was on vacation. In her email, she got a raise, and she works for the Fed.
That's lucky.
It's good.
That's not intervention.
She got a raise, and they retroed her, so she was.
I wouldn't want to
Honestly,
have,
what-
I wouldn't want to have to
Sorry,
count on
it's
that
still
happening
frozen.
every time.
Yeah.
Honestly,
Yeah.
what I would have done, I probably would have looked through her debts to see if there was anything that we could have crossed off
Yeah.
easily.
Well, they did. They were like, "Oh, you can pay the $7,000." She was like, "What? $7,000 right before closing?" Like she had her down payment, everything she needed, getting ready to turn the power, everything off, and they told us that 3 days before. And then they say you can only get a gift, so you can't borrow it from somebody.
No.
They have to give it to you.
Right.
Right.
Well,
Well, I know. But luckily, you know, she got that email.
Do you want me to
again.
do you want me to explain that to you after class? Or?
Yeah.
Okay. All right. All right. Well, one of the situations. I'm sorry. Go ahead.
I have a question about the seller contributions, because I tend to run into that a lot. We're
Okay.
a lot about
Yeah,
it.
that's what you.
Sure.
I remember.
So, is there a across the board? I know FHA is 6% allowable concessions. I know is it all conventional or just the government backed ones that are 3%?
No,
so,
it's
so conventional. If it's a 5% down or less, you're capped at 3% of the sales price for seller concessions.
Hold on.
Wait a minute. If the
5%
down
down
payment
or
is
less?
what now?
If the down payment is 5% or less,
Mm-hmm.
you're capped at 3% seller concessions.
And now, is that across all conventional or just like your government backed?
All conventional. And then if it's 10%,
between 10 and 20,
it goes to 6.
5 or 6.
And then if it's 20%, it goes to 9, which you'll never hit in a million years.
Okay, start over, Matt. 5% or less is how much?
Well, it's
Three.
tiered, so it's
Three.
Okay,
yeah.
And then 10%,
to 20.
6.
I think it's 6.
And
No,
what does
for
that
20%
look like?
now.
Is it just, let's say you get paint allowance and it has a dollar value, you have this, it has a dollar value, you have closing costs prepaid, all the money is considered a seller concession, right? Is there anything that would fall?
Did I miss the first part of what you said?
What's considered a seller concession? So not just that you've given $4,000 in closing costs, but then like you've asked the seller to give you X amount of dollars for a paint allowance or a carpet allowance.
That
Is
goes
that
into-
money
Uh-huh.
part of the
Right.
seller
It
concession?
is a seller
Right.
concession.
Okay,
Right.
so all of that is
Goes into that
seller concession.
threshold. Yeah.
Right.
So I remember once you said you could buy down, like if the seller was giving too much, you could buy down the point.
So if they're giving too much, that threshold is the threshold.
Right.
That 6% is the 6. Forever and ever, amen. That is the 6%.
You meant if they're giving too much
But-
within the threshold, and
So-
we
And-
don't have
and they
enough
go-
closing costs. to
Right, they're
cover.
gonna go over this, they're
So
going
let's
over
say
the closing.
we're not close to that 6%. We're doing FHA. We're not close to that 6% threshold. The sellers are contributing $10,000, but the lender's closing costs, everything is only $6,000. Where's that $4,000 going to go? Well, it would go back to the seller. But what we do is we'll use that $4,000. Remember the seesaw I talked about? We'll jack up that seesaw and buy down their interest rate with the seller's $4,000.
Okay.
So we're using up that whole 10, but
Yeah,
we're
no-
still underneath that.
Yeah, don't leave money on the table.
Yeah.
We don't like to
Or,
leave money on the table.
or an amendment saying, we're gonna drop the sales price $4,000.
You can drop the sales price. The
It's
problem with
it's
dropping the sales price is,
The appraisal's already been done.
well, the buyer's not getting dollar for dollar benefit.
It's also
Because
changing.
And it hurts us too.
yeah, okay. Well,
That's all you need to say.
delete that. But yeah, they don't get dollar for dollar benefit. It's much better to put it in the other way. Yeah. And you could figure out, do it side by side. It's always going to come out better dropping the rate. One of the things that we've run into is problem with home inspections. Okay? Which we haven't talked about yet today. We're kind of running out of time, but I do want to touch on this. You run into problems with home inspections that buyer and seller dig in their heels on. Okay? Can't fix one way or the other. What a great way to solve that particular problem if your lender has a plethora of renovation loans to take care of those problems, which most lenders don't. I'm happy to say that we do. We have what's called, you'll see it referred to as a mini reno, but let me just tell you what it is. It's called an escrow holdback. On cosmetic items, we can lend an additional 15% of the purchase price to take care of cosmetic items. Cosmetic items being kitchen countertops, flooring, cabinets, appliances, paint,
Bathrooms.
lighting, stuff like that.
How about windows?
No. Windows are considered structural.
Patio.
Patio, yeah. Cosmetic things. 15%. Whitney, you find you've got a buyer that's very, very particular.
So, don't, somewhere else.
Oh, go somewhere else?
Go somewhere else.
Go somewhere else.
Touchy subject, touchy
Right.
All right. Well, I'm doing one right now. Okay. And because the guy wants to redo the kitchen and the bathrooms because they're not updated. But he wanted this neighborhood. Okay? And there was nothing for sale that met his needs in that neighborhood. So he bought a house that he liked, good bones. You and I have talked about this. House had good bones, and he's going to renovate the kitchen and the bathrooms. Now, here's the catch. This house is $200,000 as it is. Renovating, so he's got 15% of 200 is $30,000. He's got $30,000 he can spend. The house has to appraise for the $230,000. Okay? But it has to appraise for the $230,000 post renovations. So in other words, the way we work this is I take your contract for $200,000, I take the contractor's bids for $30,000, I give them to the appraiser, and they go appraise the property the way it's going to be.
Yeah, I want to clarify. I want to make sure it wasn't misunderstood. We don't do an appraisal after the renovation is complete.
Yeah, I didn't want to mislead you on that.
We do the appraisal before everything is done. The appraiser is looking at it. He's looking at comps that are 230. He's looking at comps that are of similar quality and build as what you're going to be having done.
But one of the things for the next program, the Maxi, there is no restriction. You can do 100% of the purchase price, and you can do the roof, and you can do the windows, and you can do the entire basement. We have used that before when the home inspection has come up with a deck that was falling off the back and a roof that was bad. So what we did was we had to switch the buyer from a regular conventional program to the renovation. We had to upgrade the appraisal, but it saved the deal because now we can finance those things in. Okay? Now, on the escrow holdback, when you know going into it that you're going to upgrade and renovate and you're just doing cosmetics, there's no increase in the interest rate. If you're doing the roof and the deck and everything else and you're doing a maximum, it's going to be a higher interest rate. But it's important for you guys to know that these programs exist. We don't have time today to go into the details.
We do teach an entire entire class just on
right,
those four.
and we will do that because I believe it's an underutilized program. If you really understand the program, it's really incredible.
The sales pitch for you is you got your buyer that's walking through the house and they say, God, it's the right location. I love everything, but God, that bathroom is hideous. So your line
I don't have
is,
$10,000 to fix it up.
and your line is, well, if that bathroom was your dream bathroom, would this be the house? Absolutely. Perfect. Let's call Randy or Matt. Talk about a renovation loan.
Did you guys hear that?
Yeah.
Remember that verb? That's easy. That's an easy sell. That's an easy sell, and it's all legit. And gosh, let's take this same example that I just talked about. This $200,000 home. We know this buyer's going to spend $30,000 renovating, and he's going to have to do it after he moves in. So he's got 10% to put down. 10% on 200 is, plus the 30 is. So if he does it the traditional way, he's going to come out of pocket $50,000. If he does it the way that I'm suggesting, he's going to come out of pocket 10% of 200 plus 30.
23,000.
Sold.
Kind of a no-brainer. So I encourage you to sit with Paul, Matt, or myself and truly understand those programs, because it will help you sell more homes.
One question. With those reno type loans, are the qualifying criteria any different, or is it
Nope.
basically the same?
Nope, the same.
Okay.
What if they was buying a new construction and wanted to do the basement?
That'll work. We can do it.
Mm-hmm.
Yep.
So I have a client that's paid cash for a HUD home, $189. Can they now go?
They want to get
get,
they want to get their cash back out.
Yeah,
How long have they owned it?
we hadn't closed yet. Just to check it out. But they have asked me, what's the best thing for them to do? Is it to do a renovation loan, or is it to do a home equity line of credit?
Are they gonna, are they gonna buy and hold, or are they flipping?
They're gonna live here.
They're gonna live there?
Yeah,
And they're paying cash?
they pay cash.
I would do a home equity line of credit.
I do a home equity line now, and then I'd refinance in 6 months.
So do a home equity line to do your renovations
Then I'd refinance in 6 months to get my cash back out.
after the renovations.
Yep.
So they would be
Because you
worth
have a
more.
higher value.
They'd be worth more.
Right,
Okay.
right.
How long do they have to own it before they call you though? Can they call you like if they close next week? Can they
Yeah,
call
call
you
us,
the
and
next
we'll,
day?
yeah, that's what I'm saying, planning.
Yeah.
Yeah.
Planning's a big deal. Planning's a big deal.
So to get the HELOC, you don't have to own it a certain amount of time.
We don't do the HELOC.
You
I
don't do
can
it.
refer you to somebody who does a
We'll
fantastic
we'll get it done, but we don't do them.
Okay.
Okay. And I know you heard me talking about, we did a first and a second up here with Cynthia. We didn't do the second. I just found somebody that would.
Okay.
Okay. There was one more point I wanted to cover. I just lost it. Oh well. Okay. Any other questions, guys? Really appreciate you guys coming
Thank you.
and staying. Again, we want to be your partner in this situation. So we have a lot to offer. Encourage you guys to come sit with us.
I mean, really,
talk with us.
we want to make you guys successful. We're all in this. We all want to make money too, selfishly. So if you have a deal and we aren't the lender, our door's open. Come throw us the scenario, see if we can fix it and save you guys the deal.
Yeah, happy to help.
In a perfect scenario, we would just flip them to us, but
I mean, here. I thought somebody might, brag on me a little bit, but
Well, we haven't closed yet.
no, we haven't closed yet. But
But he did give the buyer another week to try to close.
she's got the buyer. She's got the buyer, and the seller said, "That's it. We're done. We're putting the house back on the market." And I'm like, it's a squirrely deal, and
He
it's
did a good job of calming the seller down and giving the buyer a little bit more time.
So I called, this wasn't even my deal.
Right.
I called the listing agent, spoke with the listing agent, and suggested that the listing agent, because she said, no, it's a seller, it's a seller. I said, well, let's get the seller on the phone. Do you mind? I mean, just let's let the seller hear from the lender. And so we got the seller on the phone, and I got him to give him a 1 week extension. I don't know what's going to ultimately happen because I think the buyer may have more issues than we know.
Yeah.
But we at least got that extended. But we're willing to go the extra mile for you guys.
I think it was a really good. Basically, Randy was good at calming the seller down and sounding confident and assuring, which I think the other agent wasn't able to do. She, but he told her exactly what I had been telling her, and I guess she had been telling the seller, but it's her delivery that was kind of off. So his delivery is good. We still hadn't closed, but he was able. And I don't want to use the term finesse because that sounds a little negative. But she just wanted to hear from another person instead of the agents, and he was real good at that.
All right, guys, thank you. Again, we want to get to know all of you and let you guys get to know us, so please come see us.
Thank you.
Thank you. Wine and cheese Thursday.
The best part about wine and cheese, you don't have to listen to us talk.
And we can
You may
bring
listen to
other
us a
people,
little bit.
right? We can bring people, right?
Absolutely, bring people, because we're going to talk about investment properties. We're going to talk about some programs you've never heard about, like you don't need income.
What time is that Thursday?
3:30. No income investment loans. That's like crazy. Yeah, right here. Right here in this room, wine and cheese.
Is it fellow agents we can invite or clients?
You can invite anybody you want. Doesn't matter to me. I think it's at 3:30. I think we moved this one up to 3:30 because the content, we're just not going to have enough time to get it in. So we had to move it up so we have enough time because it's going to be great.
Are there any new agents in here who would like to shadow someone at an open house on Sunday? Come see me and I'll tell you more about it.
She's good if anybody wants to do it.
Oh, that's open house.
Thank you, Todd.
We won a contract.
You did?
Yeah.
Hello?
Not the one you and I did. The one you and I did. I don't
The
know.
one that was
RJ. That's right.
Ridiculous.
I have to go back and look. One of the other ones I did for her still, but that's a different one. She may have sold that one. I'll have to ask her. Maybe find out something. I have to look through.
I mean, maybe
Well,
they're.
I'll do open houses anyway.
How much money do they have to bring?
The one I'm gonna do, hopefully this Sunday's in Decatur, kind of near Fullerton Highway.
I can build.
From 5 to 5, like.
Either of y'all be,
I would be interested.
You do a lot of this.
or
don't you? You know.
if you have your card, I don't have a card yet.
Right.
Okay, hold it, give me a name. Was cut, what, I do a lot of Dunwoody too.
Okay. So do you do the door knocking and all that beforehand?
If the weather cooperates, I do, which I don't know if this Saturday and Sunday, I don't know if it's gonna work. Because they're saying it may
Yeah,
rain.
try to text it, but if you text the PDF, I'm not gonna be able to see it.
The one I just did,
So is it
I
on your,
did-
is it on your, text it to me, email it?
When I just did
however
this
you want
past
to send it.
weekend,
I can look at it.
I sent out a letter
Alright.
ahead of time to all the neighbors. So it kind of depends on the neighborhood of what. Like my last three, I haven't gotten to door knock. They've ended up raining, and it's like, or it was, 95 degrees. So I have to figure out a different way of how to handle that when you can't door knock.
Okay. Here's my card, because I do supposed to do one with someone else, but I need to get back with her as far as time.
Okay.
So I'm just keeping my options open, so I have more than one.
Yeah. Well, I'll let you. I'll know later today. I'm doing it for RJ.
Okay.
And I'll let you know, and then I'll let you know when I'm doing it. I try to do 2 to 3 a month.
Okay.
And it's been mixed, but I do. I have this like little these booklets that I make up when I do a home open house, and people seem to like that. And I may present it at one of the next midnight groups.
Okay.
Because it's a little,
Do you have a card on you?
Yes.
Oh, yeah, right. And what's your name?
Sorry, Jeannie. I make
Jeannie.
real estate wishes come true.
Okay, thank you, Jeannie. And I'm Ashanti.
Well, welcome aboard. And your first name is
Tia.
T. You've been,
We've met,
yeah,
we've met.
you've been. I was gonna say you look. That's a great. Did the young lady who does the pictures do your pictures?
Yes.
I was. Let me tell you, if you haven't used her, I used someone else because I knew them, and I so wish and it was like at the time, it was $50 less. And at the
When
time,
I got ready to pay for it, I was like, these
I
pictures better look nice for $100.
but I have to tell you, she's
And then I was like-
150. But
I
I have
was
to
like,
tell you,
wow.
she's great.
I was like, okay.
I mean, I will redo when I lose the weight. I'll redo my pictures.
Yeah, I was like, well, I know I won't be taking a new one no time soon. That's gonna be my picture for
But
a minute.
it's a great. But she does
Beautiful.
her work. If you haven't done it yet, her work is. What I'm telling you is invest $150.
Yeah, because at first I was like,
Because
150 for 4. I was like, come on now. And then I was
And
like,
you met
oh.
through here? Or
Yeah,
Yes,
she
through
comes
here.
here
She'll come here.
and she'll take you upstairs and.
Oh, really? So that's outside?
No, it's upstairs.
It's up on the stairwell.
Yeah,
Oh, okay.
that's in the
I
stair.
have to
Yeah.
tell-
You
she
just go to the
does.
elevator and you just stay.
Wow.
She
Yeah,
really-
she definitely does.
She does a good job, and it's worth it.
Okay.
I wish now I would have,
But you,
Wait, that
yeah,
way,
I would
but
check with that
always-
other
Yeah.
agent to see, double check if she's still doing hers. Because I need to get all that information to figure out which way to go and the best way to do things.
Yeah, and
Like,
the next thing, then maybe this will get me to do it. The next thing I want to do is start doing where you have the people register on a computer, like a laptop.
Like an iPad stand?
Yeah.
And I have an extra iPad. I just have to find out how much they're going to charge me for my hotspot, which is why I haven't done it yet.
Okay.
But I have to tell you the biggest problem for doing open houses, even the people who do register, half the time you can't read it. And I don't know if they do it. Sometimes I don't think they're doing it on purpose. I think you just can't read it.
Yeah.
Then there's some that are doing it on purpose.
But you know what, too? I have to send it to you. A friend of mine sent me it's a sign-in for open houses.
Uh-huh.
And you wouldn't need, I don't think you would even need